Hello everyone, my name is Jeannie Schleip and today I am presenting on Universal Healthcare Services Incorporated, a publicly held hospital. Today we are going to look at their overall performance based off of their financial information. But first, who are they? Universal Healthcare Services Incorporated was founded in 1979 by Alan B. Miller, and he worked with a team of executives to establish the company. That headquarters out of King of Prussia, Pennsylvania. Over the past 40 years, they have become one of the nation's largest hospital management companies with over 350 facilities. They manage facilities that offer a variety of services such as acute care hospitals, behavioral health hospitals, and ambulatory care hospitals. Their facilities are located in 3 different countries, such as the United States, Puerto Rico, and the United Kingdom. Healthcare is a field that is constantly changing, and various organizations will face similar challenges. Universal Healthcare Services Incorporated over the last 40 years has probably faced various challenges. However, this allows them to identify their strengths, weaknesses, opportunities, and threats. The first strength of Universal Healthcare Services is their overall management. They are currently managing 226 hospitals that offer a variety of services and are acquiring more strategically on a daily basis with the help of their subsidiaries. Overall, as a company, specifically due to their strategic management, they have great performance in new markets and are remaining profitable. Lastly, they have reliable suppliers that deliver products and supplies on time. They have also integrated an automation system, bringing consistency to the delivery of their care. Now, just like other companies, they have their weaknesses as well. Currently, their profitability ratio is under the industry average, showing us that some facilities are not as profitable as others. This can be due to various reasons, such as the demographics or populations being served, payer sources, and supply chain management. They face some challenges with their supply chain management despite having reliable suppliers. Some hospitals specifically have a poor inventory forecasting method, resulting in an increase in the cost of supplies. They are acquiring high expenses due to the reimbursement policies of third-party payers, resulting in delayed payments. And lastly, hospitals in some of the rural areas of service lack the technology that can assist with delivering quality care. This now leads us into the opportunities they have as well as the threats they currently face. Universal Healthcare Services has an opportunity to decrease the cost associated with overnight shipping and transportation. By implementing a just-in-time approach for supply chain management, it will assure that supplies are always on site when needed, rather than having to overnight them due to needing them as soon as possible. New taxation policies in some states will also allow them to take advantage of this opportunity to increase their profit. They also have an opportunity to get to know their consumers' needs more in order to customize their care, specifically with the implementation of a new online platform. And lastly, the biggest opportunity they have is to take advantage of the baby boomers aging. With the aging baby boomers, there's an increased demand for healthcare services that will allow them to expand current facilities or obtain a new one. These specific opportunities will not only allow them to increase profitability, but to maintain their facilities. Now, the baby boomers aging can be a blessing, but it can also be a threat. With the increased demand for services, it creates intense competition among current competitors as well as those entering the industry, and there's also a major staff shortage across the nation. Due to the shortage, companies are increasing pay levels and continuously adding bonuses just to maintain adequate staffing. Lastly, with facilities in 3 different countries, they face the threat of currency fluctuations. This fluctuation can specifically reduce profits, increase costs, and increase the cost of care specifically for the consumers. Next, we will move into the trend analysis. To complete a trend analysis, we use the horizontal analysis on their consolidated financial statements. This technique shows the changes of various amounts of corresponding financial items over a period of time. It allows us to note both positive or negative trends, and for this specific analysis, we will show a percentage change. I completed an overall analysis using the year of 2016 as the base year in comparison with 2017 and 2018 for the income statement and cash flow statements. As you can see, Universal Healthcare Services had an 11.3% decrease in cash flow from operating activities. This could be due to overdue accounts or outstanding bills. However, the overall cash flow from operating activities increased by 13.3% in 2018 from 2017. This can indicate that Universal Health Services improved their overall revenue cycle. In 2017, they had a negative dip in cash flow from investments of 46.3% from 2016, and then it increased in 2018 to 31.1% in comparison to 2017. The negative percentage does not necessarily mean the company is not performing well, as it could be due to a number of things such as investing in long-term fixed assets. However, before a final decision can be made, it needs further investigation. In this instance, the total cash flow from operating activities is more than enough to cover long-term fixed activities. Overall, on the income statement, Universal Healthcare Services has a steady increase in their revenue and overall net income. This is a good thing to see. Operating expenses had an increase which isn't expected with an increase in revenue, especially if it means an increase in consumers. The increase in expenses is within a manageable range as well. Overall, they have a steady increase in their overall net income, but moving forward, I would like to see a continuous increase, potentially doubling the percentages. Next, as you notice, the trend analysis for the balance statement is based off of 2 years rather than 3, since the 2 was all that was included in the financial statements. Overall, Universal Healthcare Services looks to be doing well after completing an analysis on their balance statements. Their total current assets increased by 7.8%, which is a good thing to see with an increase in consumers. It looks like Universal Healthcare Services may have acquired some more property or equipment throughout 2018 to increase their balance to 6%, which helps their total assets to increase by 4.7%. Overall, these increases are good to see as they continue to strategically acquire more facilities. I would be more concerned if the numbers were decreasing. Usually, when you see a negative percentage or decrease, you get worried. However, it is a good thing to see a decrease of 21.6% in current liabilities. This shows that the company is doing a good job of paying off their liabilities and maintaining the balance in conjunction with their revenue during that fiscal year. There was also an increase of 12.6% with long-term debt, which is expected with acquiring new buildings. Looking at the dollar amount, it is still fairly low increase compared to what it could be. The numbers from their financial statements can help us get a better understanding of how they are performing as they continue to grow and maintain their facilities. However, next we're going to look at 6 of the most telling ratios of Universal Healthcare Services. There are quite a few ratios that management of healthcare organizations can look at for their overall performance. But to start off, we will look at Universal Healthcare Services profit margin, return on assets, and return on equity in comparison to the overall industry average. The profit margin measures their ability to generate revenue and control their expenses. However, this ratio shows that they make 10.9% on each dollar of revenue, and that the ratio is above the industry average, showing us that they have good expense control. Return on assets allows us to analyze how productive a business is using their assets to generate revenue. Overall, they have a return on assets of 10.7%, indicating that each dollar of assets generates 10.7% of revenue. This is lower than the industry average, indicating that there's some room for growth with the utilization of their assets. But lastly, the return on equity is a ratio that allows us to see how they are using owner-supplied capital through their investors. Now, they have a higher return on equity than the industry, showing us that they are doing better than the industry and currently generating 22.3 cents of income for each dollar of equity investment. These ratios are specifically used to measure the profitability of a company. By analyzing the profitability of the company, it allows the management to make goals for the next fiscal year, hopefully looking to improve performance. Next, we will look at the liquidity and solvency ratios. These ratios are very important since they measure the company's ability to pay off their obligations when they come due or in the event of closing down. First, looking at the debt ratio, it specifically measures the percentage of total capital that is provided by creditors. In this case, they have a debt ratio of 51%, which is higher than the industry average. This indicates that creditors have specifically supplied 51% of Universal Health Care Services' total financing. If they wanted to seek additional funding for future projects, it would be very difficult for them to obtain the funds because creditors do prefer lower ratios to cushion their potential loss in the event of the company liquidating. The current ratio shows us that in the event of immediate liquidation, Universal Health Care Services assets would provide 12 cents for every dollar of current liabilities. The current ratio is lower than the industry average, indicating that they would not be able to pay off their short-term obligations if needed. However, lastly, we look at the fixed asset turnover ratio. The fixed asset turnover ratio measures the overall utilization of a company's property and equipment. Universal Health Care Services has a ratio of 2.22, indicating that each dollar of fixed assets generates $2.22 in revenue. Now, this is aligned perfectly with the industry average. Therefore, they are using their assets adequately to generate revenue. Now that it's aligned to the industry average, this could also be due to acquiring new facilities each year, and the utilization of fixed assets may not be as high since some facilities are just starting out. Overall, Universal Health Care Services performance is good. They do a good job of generating revenue, and it seems that they have taken steps to maximize their revenue over the last year in comparison with 2017. They will need to take appropriate measures to continue to maintain their expense control as well as continuing to maintain or increase their revenue cycle management in order to maximize their cash flow. Moving forward, two of their main focus points should be 1, improving their asset utilization, and 2, improving their debt ratio. Universal Health Care Services should work on increasing asset utilization in the future to maximize their overall revenue and to reach their full potential of asset utilization. They can evaluate what assets are high performing, and they can consider selling those that are not as high performing in regards to property and equipment. With the increased demand in services, Universal Health Care Services will want to continue to acquire facilities. However, as they acquire more facilities, they need to focus on decreasing the amount of capital that is specifically provided through debt financing. In future years, they will not be able to expand services or continue to acquire buildings if their debt ratio remains higher, as creditors will not want to give them additional funds. They can decrease their debt ratio by focusing on seeking alternative options for financing. Alternative financing options can include obtaining more investors, hosting various fundraisers, receiving charitable donations, and by obtaining grants. If Universal Health Care Services can make these improvements in future years, their overall financial performance will become optimal compared to the industry.